When I was at MIT in the 1960s, everyone believed certain mathematical theorems were untouchable until we proved them wrong with data. Today, Wall Street has its own sacred theorem, the 60-40 portfolio, 60% stocks, 40% bonds. It's been gospel for generations. But here's the thing about gospel. It doesn't update with new information. I spent 40 years proving that conventional wisdom in finance is often just wrong. And right now, we're sitting in the middle of the biggest shift in portfolio dynamics since the Great Depression. The 60-40 rule, it's broken. Not because it was always bad, but because the world it was designed for no longer exists. Let me show you what the numbers actually say, and more importantly, what you should be doing instead, because your retirement is too important to leave to outdated formulas that made sense when interest rates were 15% and a computer took up an entire room. So forget everything you think you know about portfolio allocation. We're going to rebuild it from first principles, the way a mathematician would, starting with the data, not the dogma. The 60-40 portfolio didn't just appear out of thin air. It emerged from a very specific moment in financial history, a world that looked nothing like the one we're living in today. To understand why this rule is failing retirees right now, you need to understand the environment that created it. Picture the 1980s and 1990s. Paul Volcker had just broken the back of inflation by raising interest rates to levels we can barely imagine today. We're talking about treasury bonds paying 10, 12, even 15%. If you put money into bonds during that era, you weren't just preserving capital. You were generating real, substantial income that could fund a comfortable retirement all by itself. The bond portion of your portfolio wasn't dead weight. It was a workhorse. At the same time, stocks were entering one of the greatest bull markets in American history. The technology revolution was just beginning. Globalization was opening up new markets. Corporate profits were soaring. So you had this beautiful mathematical symmetry. Stocks gave you growth, bonds gave you income and stability. And when stocks went down, bonds typically went up. It was the perfect hedge. The correlations worked exactly as the textbook said they should. That's the world where the 60-40 rule made perfect sense. You could retire with $1 million, put 400 hours into bonds yielding 8%, and collect $32,000 a year in interest alone without touching your principal. Add in your stock gains, and you were golden. Financial advisors could confidently tell their clients, put 60% in stocks for growth, 40% in bonds for safety, rebalance once a year, and sleep well at night. But here's what happened. Slowly, quietly, the entire foundation of that strategy crumbled. Interest rates didn't just fall, they collapsed. The Federal Reserve, responding to crisis after crisis, pushed rates down to historic lows. By 2020, you could barely get 1% on a 10-year treasury. That same $400,000 in bonds that used to generate $32,000 a year now is producing maybe $4,000. The income engine of the 60-40 portfolio had essentially seized up. You might think, well, at least bonds still provide safety when stocks crash, and for a long time that remained true. But then 2022 happened, and it exposed something that most investors had never experienced in their entire careers: stocks and bonds falling simultaneously. The S&P 500 dropped over 18%. But bonds, those supposedly safe bonds, they fell too. The Bloomberg Aggregate Bond Index lost more than 13%. It was one of the worst years for bonds in modern history. Why did this happen? Because inflation came roaring back, and the Fed had to raise interest rates rapidly to fight it. When interest rates rise, bond prices fall. It's mathematical. And suddenly, the entire premise of the 60-40 portfolio, that bonds would protect you when stocks declined, was revealed as a fair weather assumption. It worked brilliantly when inflation was tame and rates were falling. It failed spectacularly when those conditions reversed. Think about what this means for someone who retired in 2021 with a classic 60-40 portfolio. They watched both sides of their portfolio get hammered in 2022. There was nowhere to hide. The diversification they'd been promised didn't diversify anything. And if they were taking withdrawals to live on, as retirees must, they were selling assets at depressed prices, locking in losses that their portfolio might never recover from. This is sequence of returns risk at its most brutal. But the problem goes even deeper than one bad year. We're now in a structural environment of higher inflation volatility, massive government debt, and central banks that have far less room to maneuver than they did in previous decades. The idea that we're going back to the stable, low inflation, steadily declining interest rate environment of the 1990s and 2000s is wishful thinking. We're in a different regime now. And here's the kicker. The 60K-40 rule doesn't adjust for any of this. It's a static formula in a dynamic world. It doesn't ask whether you're 35 or 65. It doesn't consider whether inflation is running at 2% or 8%. It doesn't care if bond yields are 1% or 10%. It just says 60 stocks, 40 bonds. Done. That's not investing. That's religion. And the data is screaming at us that the gods of this particular religion have abandoned us. If you're planning your retirement around a rule that was optimized for an economic environment that ended 20 years ago, you're not being prudent. You're being dangerously nostalgic. The world has changed, and your portfolio needs to change with it. Most investors have been taught a comforting lie that stocks and bonds move in opposite directions. When stocks zig, bonds zag. It's the foundational assumption underlying every diversification strategy taught in business schools, preached by financial advisors, and embedded in retirement planning software. For decades, this negative correlation was treated as a law of nature, as reliable as gravity. And then 2022 happened. Let me walk you through what occurred, because the numbers tell a story that should terrify anyone relying on traditional diversification. The S&P 500, representing the stock portion of your portfolio, fell 1% for the year. That's painful, but not catastrophic. We've seen worse. Stock market corrections are part of the game. Every investor knows stocks can be volatile. That's precisely why you're supposed to hold bonds. Except the bonds didn't hold. The Bloomberg U.S. Aggregate Bond Index, the benchmark most bond funds track, dropped 13%. Read that again. Bonds, those supposedly safe, stable, income-generating assets that were meant to cushion your fall when stocks declined, lost 13% of their value. For bond markets, this wasn't just bad, it was historic. It was one of the worst years for bonds since the index's creation. Do the math on $1 million 60-40 portfolio. Your $600,000 in stocks lost roughly $108,000. Your $400,000 in bonds lost about $52,000. Total damage $160,000, or 16% of your entire nest egg, gone in a single year. There was no safe harbor. There was no diversification benefit. The two supposedly uncorrelated assets fell together like stones. This is what we call correlation breakdown, and it's catastrophic for retirees. Here's why this happened and why it matters more than just one bad year. Bonds and stocks historically moved in opposite directions because they responded to different economic forces. Stocks loved growth and hated recession. Bonds loved stability and hated inflation. When recession fears mounted and stocks sold off, investors would flee to the safety of bonds, driving bond prices up. This flight to quality trade was so reliable you could set your watch by it. But that relationship depends entirely on inflation being low and stable. When inflation is under control, bonds are genuinely safe. Central banks can cut interest rates to stimulate growth during recessions without worrying about price pressures. In that environment, buying bonds during a stock crash makes perfect sense. Everything breaks when inflation surges. Suddenly, the Federal Reserve can't rescue the economy with low rates because they're fighting a different enemy, rising prices. They have to raise rates aggressively, even if it means pushing the economy toward recession. And when interest rates rise sharply, bond prices fall. It's not optional, it's mathematics. A bond paying 2% becomes worthless when new bonds are paying 5%. So in 2022, we had the nightmare scenario, stocks falling because recession fears were mounting and bonds falling because the Fed was jacking up rates to combat 9% inflation. Both assets were responding to the same inflationary shock, just from different angles. The negative correlation that retirees had counted on for decades simply evaporated. Now, you might be thinking this was a once-in-a-generation event, a freak occurrence we can ignore. That's what Wall Street wants you to believe, because admitting otherwise would require them to tear up every retirement plan template they've been using for 40 years. But the data suggests something more troubling. Research shows that stocks and bonds have exhibited positive correlation, meaning they fall together during multiple periods throughout history, particularly during inflationary episodes. The 1970s saw the same dynamic, so did the 1940s. The decades of reliable negative correlation from 1980 to 2020 weren't the norm. They were the anomaly, a golden age created by steadily falling inflation and interest rates. We're likely entering a regime that looks more like the 1970s than the 1990s. Massive government debt, deglobalization pressures, energy transition costs, demographic shifts, all of these are inflationary forces that aren't going away. And in an inflationary world, the 60 prize under 40 portfolio doesn't just underperform, it actively fails at its primary job, protecting your wealth during market turmoil. Think about the psychological impact on a retiree who discovers this the hard way. You've been responsible, you've saved diligently, you've followed expert advice and diversified across stocks and bonds. And then you watch helplessly as both tank simultaneously, right when you need your portfolio to support you. There's no rebalancing opportunity because everything is falling. There's no safe place to hide. This isn't theory. This happened. And for anyone who had to sell assets in 2022 to cover living expenses, those losses are permanent. You can't get those dollars back. The sequence of returns risk, the danger of experiencing poor returns right when you start withdrawing money, became devastatingly real. The comfortable assumption that diversification between stocks and bonds provides adequate protection has been exposed as conditional. It works beautifully in disinflationary environments. It fails precisely when you need it most during inflationary shocks. And any retirement strategy built on the assumption that 2022 can't happen again isn't a strategy. It's a gamble you can't afford to lose. Modern portfolio theory was revolutionary when Harry Markowitz introduced it in 1952. He won a Nobel Prize for showing mathematically how investors could optimize returns for a given level of risk through diversification. It was elegant, logical, and it fundamentally changed how we think about investing. But here's what most people miss. Markowitz never said you should set your allocation once and forget about it for 30 years. The mathematical models underlying portfolio theory assume you're constantly reassessing and adjusting based on changing conditions. Yet somehow, we've perverted this dynamic framework into a static mantra: 60% stocks, 40% bonds, never change. Don't think about it. That's not what the mathematics says. That's what the financial services industry says, because static allocations are easy to sell and simple to manage at scale. Let me explain why this is fundamentally wrong. Portfolio optimization depends entirely on expected returns, volatility, and correlations between assets. These aren't universal constants. They change dramatically based on economic conditions, interest rate environments, inflation regimes, and market valuations. A portfolio that's optimal when Treasury bonds yield 5% is catastrophically wrong when they yield 5%. A portfolio that works during deflation fails during inflation. Think about it from first principles. When bonds were yielding 8% in the 1990s, allocating 40% of your portfolio to them made mathematical sense. You were getting real returns with minimal risk. The expected return on that bond allocation might have been 7 to 8% annually. Fast forward to 2020, and bonds were yielding barely 1%. The expected return had collapsed to perhaps 1 to 2%, while inflation risk had increased substantially. Why would any rational investor maintain the same 40% allocation to an asset whose return profile had deteriorated by 75%? The answer is they wouldn't if they were actually following modern portfolio theory. But most investors aren't following the theory. They're following a fossilized rule that became convenient shorthand for a complex, dynamic process. Dynamic allocation means adjusting your portfolio based on what assets are actually priced to deliver. When stocks are expensive, trading at historically high valuations with low expected returns, you should reduce your allocation. When they're cheap, you should increase it. When bonds offer attractive real yields above inflation, you should own more. When real yields are negative, meaning you're guaranteed to lose purchasing power, you should own less. This isn't market timing. This is rational portfolio construction. Let me give you a concrete example. In early 2022, before the crash, stocks were trading at some of the highest valuations in history. The CAPI ratio, cyclically adjusted price to earnings, was above 35, a level historically associated with poor subsequent returns. Meanwhile, bonds were yielding less than inflation, guaranteeing negative real returns if held to maturity. A static 60-40 portfolio at that moment was overallocated to expensive stocks and overallocated to bonds with guaranteed losses. Modern portfolio theory would have screamed at you to reduce both allocations and seek alternatives. But the financial services industry kept telling retirees, stick with 60-40, stay the course, don't try to time the market. And those retirees lost 16% when both asset classes fell together. Dynamic allocation also means adjusting based on your personal circumstances, which change continuously. A 40-year-old with 30 years until retirement can weather extended downturns and should probably own more stocks than 60% when valuations are reasonable. A 70-year-old taking distributions can't recover from a major drawdown and needs to be far more conservative, maybe 40% stocks or less, especially when markets are expensive. Your risk tolerance changes as you age. Your income needs change. Your time horizon changes. Your portfolio should change with them. Yet the 60-40 rule treats a 35-year-old software engineer and a 65-year-old retired teacher as if they have identical needs. It's absurd. Furthermore, dynamic allocation recognizes that the investment universe has expanded far beyond just stocks and bonds. Modern portfolio theory doesn't mandate a two-asset portfolio. That was just the simplest implementation with the tools available in 1952. Today, investors have access to REITs, commodities, treasury, inflation, protected securities, international markets, alternative assets, and sophisticated instruments that didn't exist when the 60-40 rule was codified. A truly optimized portfolio in today's environment might include 40% stocks, 20% bonds, 15% real estate, 10% commodities, 10% inflation-protected securities, and 5% cash. Those percentages should shift quarterly or annually based on valuations and economic conditions. Maybe next year it's 50% stocks and 10% bonds because relative expected returns have changed. This requires more thought and more work than mindlessly maintaining 60-40 forever. But that's the point. Investing your life savings should require thought and work. The goal isn't convenience for your financial advisor. The goal is maximizing your risk-adjusted returns so you can actually retire with dignity. The mathematics of portfolio optimization are more relevant today than ever. But the mathematics demand dynamism, adaptation, and continuous reassessment. A static allocation frozen in time isn't modern portfolio theory. It's modern portfolio negligence. And your retirement is too important to base on a simplification that ignores everything we've learned about markets, correlations, and risk in the past 70 years. For decades, alternative assets were treated as exotic additions for the wealthy, something your portfolio might include if you had millions to play with, but certainly not part of the core foundation for ordinary retirement accounts. Stocks and bonds were the main course. Everything else was garnish. That hierarchy made sense in a world where bonds reliably generated income and provided safety. But that world is gone, and it's time to radically rethink what belongs at the center of your portfolio. Let's start with the fundamental problem. A traditional 60-40 portfolio only gives you exposure to two risk factors. You're betting on corporate equity growth and interest rate movements. That's it. You have zero direct protection against inflation eating away your purchasing power. You have no exposure to real assets that hold value when paper currencies don't. You're completely vulnerable to scenarios where both stocks and bonds decline together, which, as we've seen, is exactly what happens during inflationary shocks. This isn't diversification. This is concentration masquerading as diversification. Real diversification means exposure to truly uncorrelated risk factors, and that's where alternative assets become essential, not optional. Take commodities, raw materials like oil, natural gas, agricultural products, industrial metals. These assets tend to perform well precisely when stocks and bonds perform poorly. Why? Because commodity prices typically surge during inflationary periods. When the cost of everything is rising, the actual stuff that makes up everything becomes more valuable. Look at 2022 again, our case study in traditional diversification failure. While stocks fell 18% and bonds fell 13%, The Bloomberg Commodity Index surged more than 16%. Energy commodities were up even more dramatically. If you had just 10 or 15% of your portfolio in commodities, you would have cushioned the devastating losses in your traditional assets. That's real diversification, providing real protection when you need it most. Then there are real estate investment trusts rights. These aren't some speculative side bet. They're ownership stakes in income, producing real estate apartment buildings, office towers, shopping centers, warehouses, data centers. Real estate has historically served as an effective inflation hedge because rents typically rise with inflation and property values tend to appreciate over time. During periods when bond yields are low and stock valuations are stretched, REITs can offer attractive income yields plus growth potential. More importantly, real estate returns are driven by factors largely independent of stock and bond markets. They're influenced by local supply and demand, demographics, employment trends, and rental market dynamics. This means REITs provide genuine diversification benefits. When financial markets panic over interest rate changes or recession fears, real estate values are often determined by completely different factors, whether people need places to live and businesses need space to operate. Treasury inflation-protected securities, TIPS, represent another critical component that should be core, not peripheral. These are government bonds whose principal adjusts with inflation. When inflation rises, your investment grows proportionally. They're specifically designed to protect purchasing power, which is precisely what retirees need. Regular bonds promise to pay you back in nominal dollars, which might be worth far less than when you bought them. TPs promise to pay you back in real, inflation-adjusted dollars. Think about the difference. A regular 10-year Treasury yielding 2% with 4% inflation delivers a negative 2% real return. You're losing purchasing power every year. A TIPS yielding 1% real return with 4% inflation delivers a 5% nominal return. You're actually preserving and growing your wealth. For retirees living on fixed portfolios, this distinction isn't academic. It's the difference between maintaining your lifestyle and watching it erode year after year. International diversification also deserves core allocation, not token inclusion. The United States represents about 60% of global market capitalization, yet most American retirement portfolios are 90 to 100% domestic. That's home country bias, not rational portfolio construction. Different economies experience different cycles. When U.S. markets struggle, European or Asian markets might thrive. Currency diversification provides additional protection when the dollar weakens. Some portfolios should even include exposure to gold or other precious metals. Gold isn't just a relic or a speculation. It's a monetary asset that's held value for thousands of years, particularly during periods of currency debasement and financial instability. A 5% allocation to gold would have significantly improved portfolio performance during multiple crisis periods over the past 50 years. Here's what a modern core portfolio might actually look like: 35% domestic stocks, 15% international stocks, 20% bonds, 10% TIPS, 10% REITs, 5% commodities, 5% gold. Notice we're still at 50% stocks and 20% traditional bonds, so it's not radically aggressive. But we've added 4 additional asset classes that respond to different economic conditions and provide protection against different risks. This isn't complexity for complexity's sake. Each of these asset classes serves a specific purpose. Stocks provide growth. Bonds provide income and deflation protection. TPs provide inflation protection. REITs provide real asset exposure and income. Commodities provide inflation hedging and crisis protection. Gold provides monetary insurance. The old framework said own 2 things and hope for the best. The new framework says own multiple asset classes that protect you under different economic scenarios, because you don't know which scenario you're going to face over the next 30 years of retirement. That's not radical. That's prudent. And in a world where inflation can surge unexpectedly and correlations break down without warning, prudence demands moving alternatives from the margins to the middle of your portfolio. The most insidious aspect of the 60-40 rule isn't that it's outdated or that it fails during certain market conditions. It's that it treats every investor as identical as if we're all interchangeable units with the same goals, same timelines, same risk tolerance, and same financial circumstances. This one-size-fits-all approach isn't just lazy, it's financially dangerous and intellectually dishonest. Let me paint two very different pictures. Meet Sarah. She's 35 years old, works in technology, earns a solid income, has minimal debt, and won't touch her retirement savings for 30 years. Then meet Robert. He's 68, retired last year, depends on his portfolio to generate $50,000 annually for living expenses, and needs this money to last potentially 30 years through retirement. Wall Street's advice for both of them. The same 60-40 portfolio. Does that make any sense whatsoever? Sarah has 3 decades to recover from market crashes. She can ride out extended bear markets cost average through downturns and benefit from long-term compound growth. If stocks drop 40% next year, she should probably celebrate and buy more at discounted prices. Her risk isn't volatility. It's not having enough growth to build substantial wealth over 3 decades. She likely should be closer to 80 or 90% stocks, maybe even 100% during her peak earning years when her human capital is high and her portfolio is still relatively small. Robert's situation is completely different. He has no time to recover from catastrophic losses. If his portfolio drops 30% in year 1 of retirement and he's still withdrawing $50,000 to live, he's selling assets at depressed prices and creating a hole he'll never climb out of. This is sequence of returns risk, and it's brutally unforgiving. Robert probably needs to be closer to 30 or 40% stocks, possibly less if markets are expensive, with the remainder in stable, income-generating assets that won't crater when he needs them most. But the 60-40 rule looks at Sarah and Robert and says same allocation. Different circumstances don't matter. It's financial malpractice disguised as conventional wisdom. Your risk tolerance is equally personal and equally ignored by static formulas. Some people lose sleep when their portfolio drops 5%. Others can watch a 30% decline without blinking. Neither response is right or wrong. They're just different psychological makeups, but they demand different portfolios. If market volatility causes you genuine emotional distress that affects your health or leads you to sell at the worst possible time, then you need a more conservative allocation regardless of what some formula says. Your portfolio should let you sleep at night, not keep you awake calculating losses. Conversely, if you have the temperament to stay calm during crashes and the financial security to not need the money for decades, forcing yourself into a conservative 60-40 portfolio is leaving enormous amounts of money on the table. Over 30 years, the difference between a 60-40 portfolio and an 80-20 portfolio could easily be hundreds of thousands of dollars in final wealth. Your income sources matter tremendously and should directly influence your allocation. If you have a guaranteed pension covering all your basic expenses, you can afford to be more aggressive with your investment portfolio because you're not dependent on it for near-term income. If you have no pension and Social Security will only cover half your expenses, you need a far more conservative approach with substantial stable income generation. Your health and longevity expectations should factor in. If you're 65 and have serious health issues, your planning horizon might be 15 years. If you're 65 in excellent health and have longevity in your family, you might need your money to last 35 years. These scenarios require completely different strategies. The first might prioritize income and capital preservation. The second needs continued growth to combat 3.5 decades of inflation. Even your tax situation demands customization. High earners in expensive states benefit enormously from tax-efficient strategies like municipal bonds and careful asset location. Someone in a low tax bracket might prefer taxable bonds with higher yields. These tax considerations can add or subtract percentage points from your real returns, differences that compound to massive amounts over retirement. Your estate planning goals matter too. If you intend to spend your last dollar on your last day and leave nothing behind, you can use aggressive drawdown strategies. If you want to leave a legacy for children or charity, you need to preserve principal while generating income, which requires different positioning. The 60-40 rule considers none of this. It doesn't ask about your age, your income needs, your other assets, your risk tolerance, your tax bracket, your health, or your goals. It's the financial equivalent of a doctor prescribing the same medication and dosage to every patient regardless of their condition, age, weight, or other medications they're taking. Wall Street loves the 60-40 rule because it's scalable. One advisor can manage thousands of clients with the same basic template. Minimal customization and maximum efficiency. It's profitable for them. But your retirement isn't about their operational efficiency. It's about your financial security. The mathematics of portfolio optimization that we discussed earlier aren't just about adjusting to market conditions. They're about optimizing for your specific utility function, your risk parameters, your time horizon, your constraints. Every variable in those equations should be personalized to you. When Harry Markowitz developed modern portfolio theory, he understood this completely. The financial services industry stripped away all the nuance and sold you a bumper sticker. You deserve better than mythology. You deserve a strategy built for your life, not averaged across millions of strangers. The death of the 60-40 rule isn't just about its failure in changing markets. It's about rejecting the arrogant assumption that your unique circumstances, goals, and needs can be reduced to a simple ratio that hasn't changed in 40 years. The 60-40 portfolio had a good run for a generation of investors who came of age during the long disinflationary boom from 1980 to 2020. It worked remarkably well. Bonds paid attractive yields, stocks delivered strong returns, and when one zigged, the other zagged with clockwork precision. Those investors weren't foolish for following the rule. They were responding rationally to the environment they inhabited. The strategy fit the world, but that world has vanished, and clinging to its strategies is like navigating with a map from a different century. The landscape has changed fundamentally. We've moved from an era of declining interest rates to one of higher, more volatile rates. From stable low inflation to recurring inflationary shocks. From reliable negative correlation between stocks and bonds to periods where both crater simultaneously. The assumptions underlying the 60-40 rule haven't just weakened. They've been systematically demolished by economic reality. Here's what we know with mathematical certainty. When bonds yield next to nothing, allocating 40% of your portfolio to them guarantees inadequate returns. When inflation surges, traditional diversification between stocks and bonds fails precisely when you need it most. When you treat investing as a static, set it and forget it exercise, you ignore everything modern portfolio theory actually teaches about optimization. And when you apply the same formula to a 35-year-old and a 68-year-old, you're not being prudent, you're being absurd. The solution isn't to abandon diversification or take reckless risks with your retirement. The solution is to embrace what the mathematics has been telling us all along. Portfolios must be dynamic, personalized, and built from a broader toolkit than just stocks and bonds. Alternative assets, commodities, rights, inflation-protected securities, international exposure, even precious metals aren't exotic luxuries. They're essential components that provide protection against risks that stocks and bonds simply cannot hedge. Your portfolio should adjust based on market valuations, economic conditions, and most importantly, your personal circumstances, your age, your risk tolerance, your income needs, your time horizon. These aren't minor details to ignore in favor of a convenient formula. They're the most important variables in the entire equation. A retirement strategy that doesn't account for who you are and what you need isn't a strategy at all. I've spent my career proving that markets are more complex and more exploitable than conventional wisdom suggests. The data doesn't lie, but it also doesn't stand still. The same intellectual rigor that revolutionized quantitative finance, questioning assumptions, testing hypotheses, adapting to new information, should be applied to your retirement planning, not because it's complicated, but because your future depends on getting it right. The financial services industry will keep pushing the 60-40 rule because it's simple, scalable, and profitable for them to manage. They'll tell you that market timing doesn't work and that you should stay the course. And they're half right. Trying to predict short-term market movements is indeed foolish. But adjusting your portfolio based on fundamental valuations, changing economic regimes, And your evolving life circumstances isn't market timing. It's rational portfolio management. Look, I understand the appeal of simple rules. When you're facing the enormous responsibility of funding 3 decades of retirement, a clear formula provides comfort. Just follow these numbers, rebalance annually, and everything will be fine. But comfort isn't the same as security. And right now, that formula is providing false comfort while exposing you to devastating risks. The retirees who suffered through 2022, watching both their stocks and bonds collapse, learned this lesson the expensive way. They discovered that diversification is conditional, that historical relationships break down, and that strategies optimized for one economic era can fail catastrophically in another. You don't have to learn this lesson the same way. You can adapt now before the next crisis reveals the brittleness of your portfolio. So here's what I'm asking you to do. Stop treating your retirement as a problem that was solved in 1970 and never needs to be reconsidered. Look at your current allocation with fresh eyes. Ask yourself, do these percentages make sense given current bond yields, given my age and time horizon, given my income needs and risk tolerance, given what we know about inflation and correlation breakdowns? If you're still working in decades from retirement, you probably need more stocks than 60%, perhaps significantly more. If you're recently retired and dependent on your portfolio, you probably need fewer. If you're anywhere in between, you need a customized answer, not a generic formula. Bring alternatives into your core allocation. Get direct exposure to inflation protection through tax. Own real assets through rights and commodities. Diversify internationally. Build a portfolio that can weather different economic scenarios, because you cannot predict which scenario will define the next 30 years. Most importantly, commit to active management of your allocation, not frantic trading or daily adjustments, but annual or semi-annual reviews where you assess whether your portfolio still matches reality, both market reality and your personal reality. This isn't complicated. It's responsible. The mathematician in me sees the 6B40 rule for what it is, an approximation that worked under specific conditions but fails under others. We don't cling to disproven theorems in mathematics just because they used to yield good results. We update our models when the data demands it. The data is demanding it now. Your retirement is too important to entrust to Wall Street mythology. It's too important to base on rules that stopped working years ago. It's too important to treat as if you're identical to every other investor when you're not. The 6B40 rule is dead, not because it was always wrong, but because the world moved on while the rule stayed frozen in time. What replaces it won't be another simple formula. It will be a dynamic, personalized, evidence-based approach that treats your retirement with the seriousness and sophistication it deserves. The question isn't whether to abandon the 60-40 rule. The question is whether you'll do it now, while you still have time to build something better, or whether you'll wait for the next crisis to force the lesson upon you. I know which choice the data supports, and I know which choice will help you actually retire with confidence and security. The old map doesn't match the new territory. It's time to draw a better one.